Have you ever looked at all the investment options out there and just felt completely overwhelmed? Yeah, you are definitely not alone. So today, we're going to demystify a pretty unique investment tool called a fund of funds. We'll crack open what it is, see how it actually works, and figure out if it might just be the right piece of the puzzle for you, using a real-world fund as our guide. All right, so here's our game plan. We're going to start with the big picture, why we invest in the first place. Then we'll get into why picking a winner is so darn tough. From there, we'll see the traps many investors fall into, introduce a potential solution, and then really get under the hood to see how it works. And of course, we'll wrap it all up with a final takeaway for you. First things first, let's talk about the main event, right? The fundamental reason we invest in stocks is to build wealth over time. It's all about learning to ride the market's powerful, and let's be honest, sometimes crazy waves. Now, just take a look at this chart. It tells such a powerful story. You can see these huge, terrifying drops. I mean, look at the 2008 financial crisis, the COVID crash. They look scary. But here's the thing, the secret sauce, if you will. Despite all that chaos, the long-term trend has been pointing in one direction, up. That's where real wealth has been created.
And that brings us to a super important point. The scary drops, they aren't a mistake. They're part of the deal. Think of it this way. Volatility is literally the price you pay for a ticket to the long-term growth show. The biggest challenge for any of us is just having the nerve to stay in our seats when the ride gets bumpy.
Okay, so you've decided you're brave enough for the market's roller coaster. Great, but now you've got another big decision to make. Where exactly are you going to sit? The front car, the middle, or the back? Well, in the world of investing, we call that the market cap puzzle. And this leads us to the million-dollar question. Market cap is just a fancy term for how big a company is. You've got your large, stable giants, the large caps, then you have the up-and-comers in the middle, and the small, high-growth potential companies, the mid and small caps. So, where do you put your money? Do you play it safe or go for growth? This is where it gets fascinating. Just look at these numbers. In 2017, small caps were the rock stars, right? But the very next year, they were at the bottom of the pile. And look at 2009, an incredible 117% return right after losing almost 70% in 2008. The winner's trophy is constantly being passed around. There's no clear, consistent champ. And this quote just hits the nail on the head. It perfectly sums up the problem. No single part of the market stays on top forever. They all take turns in the spotlight. So trying to guess who's next, it's really, really tough. So if it's almost impossible to predict the next winner, what do a lot of us do when we try to invest on our own? Well, unfortunately, we often fall into a very predictable and often very expensive trap. It all comes down to human psychology and one powerful emotion, FOMO, the fear of missing out. We see something shooting for the moon and we can't help but feel like we need to get in on it. We jump on the bandwagon, hoping that party keeps going. Let's see what that looks like in the real world. Get a load of this number. After small cap funds had an amazing run, everybody wanted a piece of the action. Driven by that classic FOMO, investors just poured money into them. Their total assets grew by more than 1,600%. That is a massive rush of enthusiasm. And then the music stopped. The very next year, all those investors who jumped in right at the peak of the hype got hit with a loss of almost 20%. It's the classic story of buying high right before the market turns. Ouch. This whole painful cycle of trying to time the market and chasing yesterday's news, it really shows we need a different way to think. And that brings us to a potential solution, one that's designed to help us avoid this exact trap, the fund of funds. So what on earth is a fund of funds? It's actually a pretty simple idea. It's a mutual fund, but instead of buying stocks and bonds directly, it invests in other mutual funds. The best way to think about it, and you'll hear this a lot, is that you're buying a basket of baskets. I love this analogy because it makes so much sense. Picture the stock market as this huge fun fair. You've got the big, steady Ferris wheel over here. That's your large caps. You've got some faster rides, mid caps, and then you have the wild, thrilling roller coasters, the small caps. Instead of trying to pick the single best ride, an FOF gives you one ticket to enjoy a professionally chosen mix of everything. Okay, enough with the analogies. How does this basket of baskets idea actually play out in the real world?
Let's pop the hood on a specific example, the ICICI Prudential Diversified Equity All-Cap Active Fund of Funds, and see how it's built.
So, what's its mission? Pretty simple, long-term growth. But the how is what matters. A fund manager is actively managing the portfolio, deciding how much to put into large-cap funds, mid-cap funds, small-cap funds, you name it. And the idea is to stay almost fully invested across that whole spectrum.
Okay, now this is really, really important to understand. The official risk rating for a fund like this is very high. And you might ask, wait, isn't it diversified? Yes, but it's diversified across the entire stock market, including those super volatile small and mid caps. It's designed to capture the risk and the potential reward of the whole market, which means it's not for the faint of heart.
And that really tells you who this is for and who it's not for. This is built for someone with a long-term plan, someone who is okay with seeing big swings in their portfolio because they're focused on creating wealth over many, many years, not trying to make a quick buck.
So when all is said and done, what's the bottom line? Let's lay out the pros and the cons so you can get a really balanced view and see if this kind of strategy makes sense for you.
Okay, on the plus side, you get diversification and simplicity in one neat package. You're basically hiring a professional to make those tough calls on where to invest. But, and it's a big but, you have to remember that very high-risk label. Then there's the cost. This is key. With a fund of funds, you've got a double layer of expenses. You pay a fee for the main fund, and you're also paying the fees of all the little funds it holds inside. Those costs can add up. And in the end, your success really rides on the skill of that one manager making the calls.
Which really leaves us with the final question, and this one is all about you. Is the convenience of this all-in-one, professionally managed approach worth the higher costs and the very real risks for your personal financial journey? Thinking hard about that trade-off, that's how you make the right call.